Google and Meta price everything uniquely for individual users at a different point in time. In a sense that it seemed kind of one size fits all in SaaS. In reality, sometimes 4 or 5 fits all, but not really unique as I'd seen in banking derivatives.
You're now listening to Monetize, the Art of Pricing.
Hi, everybody. Today we have Gary Bailey with us, a renowned expert in monetization and pricing strategy, right? He comes from a background of banking and fintech and brings a slightly unique perspective to how pricing is done today in the world of SaaS and AI. So very excited to speak with you, Gary. Maybe we can start off a little bit about hearing introductions from the horse's mouth.
Hey, Abhishek. Nice to meet you. Thanks for the invite. Well, I'm an accountant, so really that turns people off your podcast. So I've been an accountant for 30 odd years and started with Deloitte's the standard Big Four. And then after 4 years, went into banking, probably I think end of 94. And that was at the time where banking in the UK, and I think in the US to a certain degree, was expanded massively. We had a thing in the UK called Big Bang, and I think in the US they call it the Glass-Steagall, and basically a lack of regulation or a loosening of regulation. And that enabled all sorts of transactions to take place that couldn't take place in the past. And so I got in at the early doors of the new product era of derivative bond options and all that kind of financial maths that didn't really exist up until the early 90s. And so I was in finance, but in a function that was essentially tasked with valuing derivatives, let's be fair. Derivatives and bonds, but bonds are easy. Derivative bonds, swaps, etc. And so the trader would mark his or her book, and then we would be the second line of control, having to work out what have they done, where the market pricing, Bloomberg, Reuters, etc., etc. And so that got me into the fact where it's relevant to today that we would have a book. We only had like a book of 100,000 trades, but every single one of those trades were valued differently. And so it kind of, in my mind, talks about the future of SaaS pricing maybe, or maybe more relevantly, talks to what Google and Meta do. Google and Meta price everything uniquely for individual users at a different point in time. And so I think for a while, to be honest, after banking, floundered with some of the pricing techniques that we spoke about earlier, in a sense that it seemed kind of one size fits all in SaaS. In reality, sometimes 4 or 5 fits all, but not really unique as I'd seen in banking derivatives. So last few years, I basically went back to the drawing board and said, okay, how can I translate some of the kind of detailed mathematics that we used in banking to actually create value and price SaaS products and maybe AI in a different way.
Awesome. So, Gary, thanks for that introduction, right? And that is actually a pretty unique background to come into SaaS pricing. So maybe my first question to you would be, what are the similarities and differences you see with respect to pricing in the world of finance and in the world of software that you are now pretty much into, right?
Yeah, I think the segmentation in finance is per user at a point in time, whereas the segmentation in SaaS generically is 4 or 5 buckets, sometimes 3, sometimes 4, sometimes 5. And whereas, say, in SaaS, you'll have the free plans, just say 3 or 4, and then you'll have features loaded on and on and on to the product. Normally in finance, you would basically have to retrade to get a new feature. And it could be you and I doing a loan deal. If you want a new feature, yeah, we could change the deal, but actually you'd probably cancel the old one and reissue a new one. And so in many ways, finance in the kind of 90s and now was set up to manage a massive portfolio of massively individual trades. And in a similar way, if we look at any SaaS plan, you might start here for basically the entry level, then it goes to this month features, and then you have like an insane number of features for the last plan. In reality, if we, without going into maths, because the maths is good but not brilliant, if someone's charging $100 for the entry and say $900 for the premium, the top tier, those features must add up to £900 or dollars. But no one ever does that calculation to say the sum of the parts must add up to 900. Otherwise, you're either giving away features or the features have negative values, which I assume they don't. And so just by doing that, if you Salesforce, for example, if they tried a 900 for the top tier, then if they've got 40 features in there, there's probably some sort of power law, but those features must add up to 900. So in banking, the thesis was they probably don't. They either add up to 1,200 and you're probably not valuing some of them properly if they were broken out, or you've got some features that are trashing, basically, that no one values, or value that almost detracts from the value.
I'm actually quite intrigued that banking thought about pricing this deeply actually that point of time, right? I always assumed banking to be very sales led, keep it parallel to what everybody else is doing kind of pricing, right? So before we get into SaaS, could we actually talk a little bit more about that, right? So if you had to take like maybe a couple of banking products that you priced, right? Like anything that's maybe simple for the audience to understand, right? How did you go about pricing that? That would be fascinating to understand.
Yeah, say you get a mortgage, just check it easy. Say you're a company, but you get the equivalent of a mortgage, and the mortgage is 20 years. Yeah. And so at that point in time, and it's much more popular in the US than here, you could fix it, or you could say, you know what, I think interest rates are going down. I want to pay a floating rate. So a lot of people in the US actually fix it. But in the UK, we actually mostly go floating or a very short fix, 2 years, 3 years, whereas I know in the US, it's like 20 years fixed. We don't really have that product over here as much. So Abhishek, you choose to go fixed, and that's cool. Then 2 years later, you think, you know what, I'd like to swap this into floating because I think rates are going to nosedive, but before they nosedive. So essentially, you would need a transaction to do that. And in the old way, you could just cancel the loan and reissue a new loan, or you could just basically buy a derivative on top of your actual existing loan. So you have the loan with your bank, and then you have a derivative, say, with my bank. And that derivative will have a price every day based on the market expectation, the yield curve. But similarly, if in that contract we add certain things, we would add a feature, which is we are going to look at this rate every 3 months. And we're going to look at this rate every 3 months at 11 a.m. UK time, and it's going to have an actual 360 rate. Similar to that, I'm also going to give you a discount based on your credit, which is another feature, because I'm going to value your credit different to mine and anybody else. That's a different feature. I'm also going to give you another kicker based on the fact that we've got a long-standing relationship. I'm also going to basically throw in a closeout clause, which actually have a value, an option value, which I don't throw into everybody else's contract because you're a valued client. All of these features have a value individually. The option had a feature because we could just price it on the option market. Which is the closeout. The length has a price. The interest rate you took out of the price. The credit rating, I could trade out of your credit because I said I don't want your credit risk, and I'm going to trade that separately. So if you break it out, this is very similar to SaaS. Every single one of those elements essentially is separately tradable. And so if you take it in that way, any SaaS product, let's take Salesforce, it had a database and it has some automation, then it has some ability to basically fill in the information from a tool like Zoom Info. And all of these have an individual value. And what they tend to assume is that one person values, let's just use a random example, one person values the Zoom Info integration as much as the other. So how do you value the Zoom integration as much as I do, as much as you do? That's not necessarily the case. It could be the case, but over me and customers, it's unlikely to be the case that we both value the Zoom Info integration as much as they are. And so the mere fact that we value it differently means, well, actually, I should be charging either Addy more or us more, whoever values it more, because actually it's really valuable to him. We're like, well, it's just trash. We just don't need it because we don't even use Zoom Info or whatever. And so each of those features within that bundle adds a unique value that a banker would actually break out and try to trade it individually and then see where he can or she can hedge it, where they can hedge it, where they're taking a margin. And all of those are tradable and hedgeable, and you could argue. But what we tend to do is bundle in every single feature we can get our hand on. And then there's a continuous list of features added because we're spending 25% on R&D. That would never happen in the banking environment.
In a way, it feels like what's happening to SaaS very recently, banking has been doing for a long way back, right? I don't know if it's as systemic, but thinking about pricing and hedging at a feature level based on usage and user, that's what you're saying essentially, right? Like how you wanted to call it at that point of time. So very, very fascinating. But it seems like a long way away from where you are now doing pricing consulting for SaaS, right? So a couple of things I want to touch upon. One is we will get into specific examples of how to price and what goes into pricing, how does the exercise work, but also about a journey of being a pricing consultant, right? Like, so we do speak to people in that space, and there seems to be a little bit of trepidation across customers or across companies that, hey, how can somebody externally come in and kind of like, help something that's very key to it, right? Like key to what we do. So how did the journey come about for you, and how did you realize this was something that could be really helpful to the companies that you're going to be working with?
Yes, well, thanks for the question. It's a good point. I basically had to try to put it into a framework, because essentially I struggled for about 2 years, and I read all the kind of psychology books, etc. And then actually pricing is really a mixture of a few things. It's economics, which I do like. Then it's maths, a little bit of maths, not too much, and psychology. And if you add that to a little bit of marketing, you have SaaS pricing bundled in. So I was looking for areas where the mathematics came in, just in logic, the way things look, and then saying, okay, where does psychology come in? And all sorts of tricks, the 99, the less than £100, all sorts of shenanigans you can do psychology-wise. And then you got the marketing part. And then it was like, okay, if you add the economics in, supply, demand, and all the elasticity, you literally have the 4 disciplines that make up pricing. And so if you know that, then you start to look for trends and kind of think where that actually makes sense based on that framework. And one of the best cases I can see is HubSpot. And there was a thing, if you look across the successful prices or successful SaaS companies, they had this kind of parallel pricing thing going on. So they would have like a graduation of pricing. So the entry price might be, let's just say 1, could be 100. The next price would be 3x, 300. The next price would be 3x that. And that's based on Pareto. And you think, okay, who's using that? And then you look at HubSpot and similarly Salesforce for a while. And HubSpot was pricing like the entry price was quite cheap. And then it went up to 12x and it went 64x. So it still followed a power law, which you could say, actually, wait a minute, they've done a Pareto there to try and maximize demand all the way out the curve. Now, obviously, we were saying in banking, you wouldn't do that because you'd have hundreds of thousands of trades. But for SaaS, if other companies looked at it, they would say, well, if HubSpot's doing it, why am I not? But they're not. So you'll find some people who do entry price, they just make out $19, next price $39, and the next price $99. That, in economics terms, is leaving some money on the table, because there should be a graduation of the price all the way up to the top. So at the top, really, you should only have 1% of people willing to pay that price. And then it goes down, etc. 3.2%, 16%, down to 84%. So just following the principles, and you look at which SaaSs are doing it, and you're like, well, HubSpot's doing this, so they've been doing it after year 2 for 14, 15 years. You're like, well, why are you not just copying Salesforce? But people aren't necessarily looking at there's a mathematical relationship why they priced each individual plan from 1 to 4 in that way. And so you look at those correlations and relationships and say, well, without doing anything fancy, there are simple economic relationships, mathematical relationships, Pareto and stuff, which you should be doing. And then
why do companies, sorry, go ahead.
No, go. So why do companies?
So my question is, why do companies settle for the good, better, best, right? I mean, for a good part of like decade and a half, like since SaaS has really been a thing, or even slightly longer, that's been acceptedly the standard way to price, right? Like, I mean, it is pretty clear it leaves money on the table. It's not how general supply demand should work, like you said, but that's how companies have done it, right? Majority of the companies. Why do you think that happened?
Yeah, the good, better, best is perfect. It's just that the points that they put on it tend not to be. And so I think HubSpot is a perfect example, because you start at £100, then you go to like 800, then you go to an eye-watering amount like 2,400. Now that is good graduation, because only very few people are going to pay the 2,400, but you've exhausted the full demand at the price they're willing to pay. Similarly, you would say, okay, the reason why they've done that is they know that at the top end, they can do a different sales motion, etc. And also, the minute someone looks, if you and I look at HubSpot and we don't know anything about it, we're going to say someone in this world is willing to pay £2,500-ish for this product. I am getting a bargain at 100. So all the elements that HubSpot already were doing for 10 years, the anchoring up top with the crazy price, 2,400, the graduation, good, better, best, is standard like day one that you should be doing that.
It just seems just a little easy, right? Like in the sense, the process of doing that is just more easy rather than actually. When do companies start thinking about this the way you do, right? Like, okay, so you start a company, you kind of like price it in the easiest way, good, better, best. But then when do people start thinking along the lines of what you're talking about with respect to HubSpot, right? Like, when is it a good time to start thinking more deeply and say, okay, wait, we're leaving money on the table. We should be doing this slightly more scientifically or mathematically. Like, typically, when do you see the inflection point happening in companies?
Not for the first 2-3 years, actually, because essentially everybody's head down trying to scale volume. And so in many ways, they're scaling volume and they're seeing that volume scaling is related to the product. So they're putting more money in the product and more money in Facebook Meta or whatever go-to-market motion. And in reality, Abhishek, is if you have an accounting person in a firm, then they're going to want to produce accounts. They're going to do bookkeeping. If you have a compliance person in the firm, they're going to probably overdo the compliance. So if you had a pricing person in the firm, they're going to do pricing. They're going to do a pretty damn good job. But if you don't have a pricing person in the job, it's similar to trying to get me to do some SQL queries. I'm okay, but I'm not a programmer or Python. I'm okay. I'm going to do a kind of not very good job because it's not my day job. And I'm not actually that interested in it. So I think the cool problem, Abhishek, is that there is no nominated person to go down a rabbit hole and say, well, I'll just do best practice. Look at Salesforce, look at HubSpot, look at Zoom or whatever, and just work out. And so I think it's not the skill set, but they can learn the skill set just by looking. I think it's the lack of a person who is dedicated to doing it, even part-time, in the main issue.
Yes, I do agree with that point, right? Like, and I think even the current change in respect to how companies are looking at pricing is coming from a place where more and more product folks have gotten into pricing, right? Like, as against originally there's probably a finance problem to solve, right? And as more product folks come in, they're looking at it while building the product, right? There are now talks about, hey, we should be thinking about pricing while we think about product as well, right? So this is a good question for me to ask you in that case, right? So who is the person? What does he or she need to be, right? I mean, how do you become a pricing person within a company or even from externally, right?
Yeah, it's a good question because I like to throw it up in that. And I'm saying that in reality, that category of person doesn't exist. And so we were just arguing or conversation about, okay, look at all the new things that have come about. And so Addy's now a podcast producer. Now, or no way he could have said that 10 years ago. Well, maybe 10 years ago he could have done, but if you said it to a careers person or university lecturer, and they're like, what's this guy talking about? So in many ways, if you look at in our world, in tech and stuff, obviously I'm older than you, so I've come from when we would call them the IT guy, all the way to now you have to really segment, no, he's full stack, he's DevOps, etc. But the best example you can say is a DevOps. And so DevOps is a made-up name. It kind of sounds what it is, but it has to be made up by someone. Someone has to say, we're moving from on-prem to cloud, and hence we need a kind of more dynamic person. And you couldn't say you were undynamic in the old way, but you need a person that's much more dynamic, much more kind of tools focused, integrated, and things are moving faster than they were used to. And in a very similar way that I first was growing up in banking, we had project managers. And even now, if you say you want to be a product manager in a bank, they don't really like it that much. A little bit more, but it's not like, well, it's standard. Well, we're going to, no, they still want project managers managing discrete projects where the product manager is continuous. And so I think in a very similar way that someone stood up and said, oh, don't call me a project manager, whatever you do, for whatever reason, many years ago, Guy Kawasaki, whoever, someone has to stand up and say, yes, I'm a product guy or girl, but actually I'm a pricing product person. And I think if they did that, Abhishek, it would move from generally companies don't change pricing more than once every 6 months, which you're lucky. Could be a year, 6 months, occasionally 3 months. But 3 months is actually a massive amount of time compared to the big companies that are changing it, big tech companies, changing it hundreds of times a week, actually. And so that journey needs someone who can work with tooling, who thinks dynamically, who wants to A/B test pricing, which isn't really done that much, really, and wants to constantly be repackaging stuff based on new segmentation that comes up. And so if I give you an example of things that I knew nothing about, or every time someone would say it, I was like, well, what the hell is that? So someone like, it could be segment. I listened to the story years ago, and the guy who left YCM and they didn't know what they were doing and stuff. And then he created a thing called a CDP around it. You're like, okay, why do you need a CDP? Well, you need a CDP because you want to know that the CRM's okay, but actually it doesn't show you what people are doing. So then you need a CDP. And you're like, well, someone invented that term, I don't know if it was him or his company. And then like everybody's got one now, or everybody thinks they need one, and they can't afford it. So in similar way, if I've got a CRM, which is good, so someone's done some segmentation, marketing or whatever, and I've got a CDP, so someone now can tell me insane amounts of data about how Abhishek is actually using the product. Okay, so what do I do with that? Just throw it off a cliff? I can feed it back into CRM, but even if I feed it back into CRM, I've only got 3 plans. Where am I going to go? I can sell him more product and NRR stuff, but actually, you and Addy could have wildly different use in the same top tier, but I've got nothing to do. What can I do with that information? So now there's another piece necessary, which I'm messing about with name, value capture management systems, or something which is like your system, like many others, which is actually I want to experiment now with the usage data that the CDP gives me, and I want to see where the value capture and value creation is coming in. And that allows me to resegment further. And so in many ways, to answer your question, it's like the person that can look at that journey, say, CRM is the marketing, salespeople, then you've got CDP, which is the kind of product analytics. Okay, so between that and the actual price and the actual billing, there's a missing piece, which is, who's going to actually work out the usage, not just calculate it, the value of the usage in terms of who's getting value, and actually change some of the monetization around.
A lot of teams, actually, a lot of companies are opening now monetization teams, right, over the last 5-6 years. And that's been a phenomenon that we're seeing a lot of companies coming up with. And that's great. I think this could be an onset of pricing manager being an ubiquitous job, like how product manager has become in the last 2 decades, right? Hopefully in the next decade, I definitely see a world where that's going to be, each company is going to have maybe, if not as many, but definitely certain roles that are specific to pricing, right? So let's talk about that more specific, right? Like, so let's say there are companies today that has a pricing manager, or a company wants to think about pricing. They want to hire a pricing consultant, right? How would the process, what would happen? So I'm a startup founder. I start a company, I scale it to some level, and I start thinking, okay, now I need to think about pricing. I hire somebody or I hire a person. What is their day job like? How would they go about? What are the tools that they use? Could you throw us some specific light into a life at work, or a day of how a pricing manager works?
So let's use a real example. Say, I don't know, which image tools do you use? Are you using DALL-E or I use Leonardo? Say like one of the AI tools, big company, bought
Let's
by
take DALL-E. Let's take DALL-E. Yeah, perfect.
Yeah, Leonardo, bought by Canva. It's perfect. It's really, really good. It's a different version of, compared to Midjourney. Australian, really good design, looks beautiful. So I don't know how much I pay. How much do I pay? I think their pricing goes from about £20 up to about 60, 70, like that. And so before we do anything, say that product is semi-developed, and you say, okay, we have an AI image LLM stroke model. Who find value from that? So currently they pushed it out and it's beautiful. They did a freemium, then they did a price, it paid, etc. So the first question we have to ask Abhishek is, we need to, before we do anything else in pricing, try and work out mathematically how much value it creates. And that's where it gets a little bit hand wavy in pricing, and people say it's a conversation now, but this is not a conversational tool. There is no sales team getting on the phone trying to sell a £20 package a month. So let's use you as an example. We're saying we have now this AI image tool. I somehow need to work out how much value it can give you, and then maybe 4 or 5 other segments. And so I did an example the other day saying, so imagine an AI image tool. I'm an accountant, I use it. An architect can use it, slightly more, going to get more value than me because I'm just going to post LinkedIn. And then you could say a graphic artist use it, even more money. And then you could say, okay, maybe a graphic artist who's running an agency can get even more value because now he or she can run an agency on acid, basically just pumping out pictures and images. And so as you got that, we work out for each individual, for an accountant, say for a founder, how much it's worth. Then you say for an architect, all the way up to say a graphic designer. You say, okay, these have different value points. For me, yeah, it's worth like £10 a month, £20 a month. For the person running the agency, it could be worth thousands because they can now take on contracts at £2,000 a month and just chuck out 500 images to that individual payer every month. So the first thing before we do anything is calculate the value they could deliver for different segments, actually put it on paper, and then put it out to them, and they can throw it back and say, no, that's just ridiculous. There's no way you create $500 or $600 or $1,000, but you prove it mathematically and say, I believe it can create this much value to you. And then the next question you ask is, what is the risk of them getting that value? So if you, just like when you're using ChatGPT, the answers are wild, and there is a skill to prompting. I don't fully have a perfect skill. So therefore my chance of getting a really good image is less than the person who's very skilled. So my chance of actually getting that output, that value of say 10 might be, let's just say 20%. So my value is really 2. But as you go up, you might have, okay, the value for the person paying $1,000 is 50%. And so the question is, you've got now a real estimate of the value that it can create for them, and you've done some surveys and stuff with them and say, look, and you get back and forth, but you've mathematically proven it. Then you've said, okay, what's the risk of delivery of that? And then after you get that number, say it's 50%, then you say, okay, how to...
Sorry to interrupt you there. I apologize for that. But before you get into that, like also, how do you go about the process of getting this information, right? Like, so you briefly touched upon surveys and stuff, but can we touch a little more deeply as to how do you processify this entire means through which you get information on which you can make the decisions?
Yes. So say like the AI image is a good one because it's easy and everybody's using it now. But so someone in marketing would have said, you know what, we think we have, let's just make up 5 different ICP types, from an accountant just posting on LinkedIn to an architect to a graphic designer individually on Fiverr to an agency all the way up. So someone in marketing, and if not, the person in pricing can just say, well, I think the ICP could be this. So then they will say, okay, how do we estimate the value for that ICP, those 5 ICP? At the top end, you would say, well, okay, what is an agency going to do? An agency is going to take this product, use an API, get some clients on board, which it already has, and those clients basically want graphic design. So then we have to work out what is the lift for them to be able to use the tool, that's the onboard and stuff, and how accurate is this tool, the risk, in delivery of what they've been delivering manually for a long time. So taking that concept, you've got the ICP, which normally every single startup has at least a guesstimate of the top 3 ICPs. You can add to it. But what they don't always do is, what is the value of the ICP in terms of what it creates for Abhishek? Yes, Abhishek is a free user on ChatGPT, but actually, what's the likelihood of him getting really, really good results? 20%. So therefore, his ICP will pay £10, £20 a month with a 20% risk, which means he's worth 20 times 0.24. So that's not good. So as you move up that, you're able to show people and then argue with the founders, etc., and the marketing team and say, I think Abhishek's only going to get $4 worth of value out of ChatGPT. And they're going, what are you talking about? Well, you charge him 20 and he's got a 20% likelihood of value extraction from it without wasting his time. And so as you move that, then you cut a chart of how many basically ICPs times the value creation times the risk of the creating value. And then you come up with a number which said, okay, this is the risk adjusted value creation. And then you can go out and test that with people and say, okay, we've surveyed with 5, 10, 15 this is what we believe your value creation, and we're going to prove why you can create this much value, because you agency are going to generate this many queries and be able to onboard this many clients. And like anything, they can push back, but you already have a very solid 2-tier calculation that shows that you've created value.
That brings me to AI, right? Like you spoke about how to break down pricing for a company like like DALI or Midjourney or an imaging tool with AI. Do you think with the advent of AI coming in, the way companies are looking at pricing has actually dramatically changed, right? I asked this because I see a lot of conversation about it, right? A lot of founders talking about, hey, in this world, how are we going to price? What are our costs are fairly expensive, and how are we going to price? Is this going to go back to traditional cost plus plus models, or this value per user? What is the value creating that we are creating, and how do we price that, right? So how do you see pricing being different in the AI world, right? And do you think there are companies who figure it out yet, or is it still very much in the face of experimentation with respect to pricing?
So I think they still have to experiment, but say the AI thing kind of breaks it open back to the banking day. Because essentially it could just be made up. But even yesterday I heard on TechCrunch where Salesforce think they're going to launch 1 million agents or something in the next year. It's probably insane, but let's say they launch 1,000. So that means you have 1,000 agents, which could all be priced differently. So where we've moved from they have 5 price plans and loads of products and stuff in the platform, they're going to need someone to basically price 1,000 different AI agents. They can't really just stuck $2 on it. That's fine. Okay. Because they're big, they can afford that. But you, the startup, can't afford to just copy a behemoth. But you have to think of something a bit more original, because otherwise they'll just might as well go Salesforce. So if you look at the agent world, which if it does come in, agents are really just jumped up features that talk, continuous talking features. So that means we come back to someone needs to price every single feature, because an agent is a feature. And then you bundle them together into a product if you want to. And so everyone is going to have to move from, I had 4 pricing plans with packaging and all sorts. And now the product managers want to release 100 agents a month. Someone's going to have to come up with a price for those agents. Someone. With a bit of testing, guesswork, but they can't all be $2. So whether people like it or not, things are going to change.
That's also a reason I kind of like think this pricing is not something that's you talk about how pricing is not there in every company, right? Like, so Salesforce is a great example, right? They're thinking of moving pricing from just user to, in this space, about resolution, right? Like or per conversation, right? So now that's a big thing, and on the earnings call, they made a statement like this, right? Now it looks like a pricing for this product has been solved, or for a matter that then now they know what the pricing is, right? Then what does the job of the pricing manager again become, right? So is the problem that people think of this as a one-time problem? Okay, somebody comes and solves this, and then cool, they can go do something else, right? Or do you think this is something more continuous? Because you keep saying that, hey, could we price all of these agents differently, right? As against $2. So is this a continuous job, right? Like that, and is there a place where you see companies evolving to where they are getting super granular with pricing at a customer level, or thereby making it a continuous job? Today, do you see that happening in any companies, or do you still think this is something that, hey, we do once a year, once in 6 months? Or
no, I think if we look at the companies that don't say they're pricing companies, which they pretty much are, and they are the Googles and the Facebooks and the Amazons. So, and we kind of ignore what they do because they don't start telling people that they're all about monetization. But there is no better value capture machines than Amazon, Meta, and Google. So then we say, okay, why are they so good at value capture? One, because they put a lot of engineering time into it. They're constantly analyzing and changing pricing. 2, they're much more dynamic. 3, they basically have units that people can buy into, whether it be ad units or see on Amazon, it's a bit different. Amazon's willing to change their prices like 2.5 million times a day or whatever prices. So they have basically a setup which is how, like an airline, how can I maximize this seat? Nothing has changed. I don't think there's anything new in any of this pricing stuff. Airlines extract maximum pounds or dollars from everyone. they've been doing it for 30 years. Google copied what airline did and added a little bit of economics to it and price auction stuff. But it did exactly what airlines have been doing for 30 years. So there's nothing new that the pricing people in SaaS need to do. Just look at the airline and look at Google and Meta. And if you can go anywhere along that journey towards them and Amazon, you're doing okay. And so I think AI agents are going to be the personification of the Google per click or the Meta per click model or the airline seat per click model, because they've been doing it for a long time. So I think we've got away with 3 or 4 plans. Well, that's lovely, but not that profitable. Let's be fair. Not many SaaS companies can go public because they're not that profitable. I mean, the reason, it's not because the product's not good. The product's fantastic. The people are smart. The product's fantastic. The go-to-market is good. There's only one thing left. The pricing must be wrong.
Goes back to the 4 Ps and where the P you're missing. Fair enough, right? But is there a slight difference in the way like B2B and B2C works, right? Because when it comes to SaaS, then again, it also becomes how the buyer thinks of it, right? You're typically selling to a more rational buyer than somebody buying on Amazon, right? So can you afford to be in a place where you are changing pricing that often or trying to go super granular? Does the customer then get a little, it's not like you're hunting for the best price in some way, right? Like it's a whole different kind of buying persona. So do you think the same rules apply in both these places?
Well, I suppose if you take cloud as the example, there is no person on earth that can work out their cloud bill at the end of the month. So I think they would Plato, Socrates. There's no one that can predict that. I've used AWS. There is no one on earth that can predict that, because each instance, does the instance run too much at the runtime? There is no one that can work it out, and yet everybody uses a cloud. So these companies, the cloud, AWS, Azure, these companies are killer value extraction, value capture machines. And so it's the same example of the cloud. Amazon, I don't seem to produce like a product every week that they chuck into AWS. So they're doing exactly what we're saying for SaaS. AWS has been doing it. They don't deprecate anything. Everything's new. So I think there's nothing new that we need to learn. We just say, okay, well, let's look at AWS. Every single one of those, DynamoDB, CC2, Elastic, they're all separate features, and you can do what you want. You can add them in, take them out. Here's the console that shows you how much you're paying, the instances that are overrunning. This is your cost base. There's whole consultancies that just do optimization of cloud costs. Literally, big 4 firms make lots of money out of it. So we've seen already the examples of exactly what good looks like from a value capture perspective. I think SaaS just has to just look at AWS and Azure, no more.
Is there a late stage problem in that case? Can an observation be made that the product has to be so core or so key to what you do before you can actually think of pricing in such a sophisticated manner, right? So does by nature pricing become a late stage problem beyond, let's say, once you're beyond the 50 million of revenue? I'm using the revenue as a metaphor for the importance of the product for the customer, right? Like, so whatever metric, does it by nature become a late stage problem because general advice is starting about pricing on day one, right? But is that practical? I mean, theory is great advice, but is that even practical? Do you even have the power?
You do, yeah, because essentially, if you assume a product is really a platform, a product with more than 5 or 6 features of the platform. So if you basically up your whatever the product is, it could be, and you say it's actually a platform with a bunch of products underneath it, and then you're saying, okay, well, I didn't need to price all of these, and I need to enable Abhishek to be able to bundle what he wants. Now I'm doing the bundling for you. But AWS doesn't do the bundling for you. It basically says, yeah, we'll do consultancy, we'll have a chat and discuss whatever, and we can keep it in line and up to date. But AWS doesn't say, here, take all these things at one go. It says, have you got a problem with database? And take Dynamo. Have you got a problem with storage? Take this. And so does Azure. And so in many ways, they started with just one product in AWS, and then they kept on adding to them. Some people didn't take the second product or the third or the fifth. Some people took the 6th. And so what they enable people to do, which I think is the future with agents, is even though we're working for the same firm, we're both using CRM, we're both kind of premium users of, say, Salesforce. You've unique your profile in a similar way that you would use Notion in a different way around you've mentioned. You've got certain templates, you've used the community from Salesforce, you put together your package, and I've been transparent and showing you the price of those, and you can check it out in the user group and stuff, just like you can with AWS for different database instance sections and storage. But you've personalized your bundle. And so the beauty of that is, like SAP or any other industrial military system that once you put in, you never want to jump out. You now have created a perfect profile for you as a salesman. Similarly, if you take on someone, well, you're going to literally just copy and paste the profile. That's your logical access. Similarly, if you're one of the best sales leaders in the firm, they're going to say, wait a minute, why are we messing about? Abhishek's got the perfect profile. That is the template for the profile. That is the feature list that we're going to all put together for this group. And then someone usurps you, when they say, no, actually, it's Adi. Adi got a better product because he's doing better in sales. Look how fast he is. He's just fishing. And so you create this kind of Notion concept, but in the same way AWS. There is very few firms that can say my AWS instance, even if they're in the same field, selling the same product, is the same as someone else's. Whereas in CRM, they can. My instance is pretty much the same as everybody else's. So I've really nullified that benefit I could have got from using a system, whereas AWS doesn't do that. No, you perfectly select your AWS package, and then someone else's may be using similar tools that won't be same as yours.
So as a last concluding question, right? Like, so I know you have pretty strong frameworks that you work on, especially when it comes to pricing, right? Like, I've read a bit of it. So maybe we can leave the audience with a little bit in-depth breakdown of the frameworks around which you go about pricing. And maybe that'll be a good way to conclude this conversation as well.
Okay, so say if I was trying to teach someone, which I did last week, basically saying there's 5 steps. The first step is, okay, right, the ICP, work out the value creation for each one. Step 1. And the second step is, okay, work out the risk of value kind of receipt. I mean, yes, there's value creation, right? There is with LLMs, for example, but the actual risk of that person getting it, given their ICP, given their knowledge, is 10, 20, 30, 40%. So you times those two. First step, calculate value creation. Next step, the risk of actually them getting that value. Then you have a number which is, okay, here's the risk-adjusted value creation. Then you say, okay, what share can I capture of that? What is fair? We know that Facebook captures like 40%, recently, because they 2.5 ROAS. We know Google captures about 40% of the value they create, because most agencies say, well, actually put $100 on and you're going to get $250 back. So we know how much they captured. It's like, okay, I'm not going to take as much as 40. We know Amazon captured like 15, 20% on platform. We can see that. DoorDash, so we can see what platforms capture. You say, what percent am I able to capture based on economics, competition, uniqueness, relationship, etc. Say on average, it should be between 5 maximum. So for a normal SaaS, they can be up to 10. So then I capture 5%. So now you've got the framework of created value, risk-adjusted value creation. What percent can I capture on that we've agreed with the client in the market? Then you say, okay, now I need to put it into a monetization framework, which is, how do I actually collect that agreed 5%? What system do I put in place? This is where you come in. How do I calculate it? How do I respond? How do I put a console? How do I show the client I'm capturing that much? How do I actually show my team, feed into finance, etc.? And then the last stage 5, is that needs to be represented in a price point that is coherent. Yes, I know we've agreed 5% between you and I as a client, but actually I need to put it into a price point that you think, yeah, I get that. And it could be 20 cents per call, $2 per call, £20 per month, blanket $2,000. So it's in a framework which you can coherently understand. But really, the pricing, which something to start here, is really only the last coherent phase of actually you've done all the work before. And the client can see you've done all the work because you've proven to them and say, yeah, okay, we like that reference point. We like that traditional way that you've stated pricing. Now I can send it to my boss.
Fair enough. Thank you. Thanks, Gary, again for that summary. And it was a lovely conversation. Thank you again for your time.
Thank you. Nice to meet you.